So, Unit 7. We're on the home run now, and Unit 7 is something, again, that a lot of middle class Nigerians care about, very close to our hearts. We all talk about it. We all weep when dollar is high. We all like it when dollar is low. We talk about dollar every day. Dollar is very important to us. When there's no dollar for us to travel with and pay school fees with, we all get upset. So this is about the US dollars. It's about Forex, foreign exchange markets, the markets for foreign exchange, the nominal and real foreign exchange rate, purchasing power parity of different countries, and how exchange rate affects our economy. And I'm sure everybody knows that Forex, the last Forex crisis took a real big toll on Nigeria. So Forex is something really important for us, and something that every Nigerian that wants to debate intelligently about economic policy should understand. So I'm just gonna start by talking about globalization. Globalization is a way that national economies are so connected to each other, and something that happened in Iran can affect Nigeria's economy. Something that happened in China can affect Nigeria's economy. When China goes into recession, or when our biggest trading partners go into recession, we feel it in Nigeria. So that's because of the effects of globalization. Now, the nominal exchange rate. Sorry, I just need to drink some water. Jeez, I've been talking so much. Hmm. Okay, we're good. The nominal exchange rate is the rate at which currencies of two countries can be exchanged, while the real exchange rate is the ratio of what a specified amount of money will buy in another country to the compared with another, well, in one country compared to another. Now, the law of one price states that identical commodities should sell at the same price wherever they are sold. But obviously, that applies to tradables. So if you buy an iPhone in slots, it will cost roughly the same amount as it would cost in an American Apple store. If you buy a computer in Computer Village, as long as it's not fake, it should cost the same amount as it would cost in America. If you buy a Louis Vuitton bag, for instance, it costs roughly the same amount that it would cost in America. But it applies to tradables, not services. So with services, if you want to braid your hair in Nigeria, for instance, not all Nigerian hair braiders can go to America. So braiding of hair in Nigeria probably costs about, I don't know, maybe like to do a full braids of a medium size. Maybe if you're doing it under the bridge in a local area, it could cost you maybe, I guess, 2,000 naira, which is about $5. So between $5 and $10 for a set of really really good braids. But if you go to America and do the same head of braids, it's going to cost you like $250. Some people even charge $400 for braids, because those are not easily tradable. You can't just get all those people that braid hair under the bridge and just transport them all to America. It's not, services are not easily tradable. So because of that, the law of one price doesn't apply as acutely to services as it does to tradable products like iPhones and Louis Vuitton bags. The PPP, or the purchasing power parity exchange rate, is the exchange rate that the same basket of goods costs in one country once the allowance is made for different currencies. And the Big Mac Index by The Economist is a good sort of idea of a purchasing power parity. So, in Switzerland, for instance, which is quite an expensive country, a Big Mac costs $6. In India, it costs $2. In Egypt, it costs $1.46. And this is because even the like the basket, like I think the Big Mac itself, if you look at it in a way, it's kind of a basket of goods, right? Because you've got, I think, something like salad, like cabbage, you've got your meat, you've got that thing that looks like a cucumber, you've got tomato ketchup, you've got bread. So it's a basket of goods on its own. So the Big Mac Index, you know, um, is a way to gauge whether currencies are at their correct index. compared to the US dollar, or the correct value compared to the US dollar. And you can see that because there's a service component in it as well. So people have to make the Big Mac, they work per hour in McDonald's. You can see that the difference, it shows acutely sort of the difference between different areas of the world in terms of what it takes to produce a Big Mac, which gives a good idea of purchasing power. Balance of payments. So the balance of payments is really something that comes up continually, especially for Nigeria and developing countries. And the balance of payments is a statistical record covering a particular period of time of a country's economic transactions with the rest of the world. So, um, how much are you transacting with the rest of the world, and are you winning in those transactions? So I think Donald Trump has been obsessed with America's balance of payments because he feels like America has been cheated, it's making really bad trade deals, and they're not optimizing their balance of payments well enough. So the balance of payments really consists of the current account and the capital account, even though some people divide it into the financial account and the capital account. But for the purposes of this video, just call it the current account and the capital account. So the current account is a record of all payments in goods and services plus income flow. And it's four parts. So it's a balance of trade in goods, so visible goods, the balance of trade in services like tourism, insurance, the balance of net income flows, so primary income flows like wages and investment income, and net current transfers, so stuff like aid, basically like government transfers to the UN and the EU and stuff like that, and that all makes up the current account. So I'll give you some examples. So in terms of trade, balance of trade in goods, a country like China, for instance, would have a strong balance because they produce a lot of goods. A country like Indonesia, where Bali is, places like Thailand, they might not produce so many goods, but they definitely produce services like tourism. Loads of people go there on holiday, so that would have a positive balance there. Um, or that would indicate a positive balance. And then wages and investment income, and then countries that government transfers to UN, EU, those kind of things as well. For the financial account, this is records of all financial transactions. So where the current account occurs to things of more like business orientated spending, this is like finance and capital type spending. So it talks about direct investment. This is investment from people from abroad. So if a UK firm built a factory in Japan, it would be a debit on the UK financial account. It would include portfolio investments such as bonds, savings, that kind of stuff. And then also hot money, which Nigerians also are very familiar with. So foreign investors that come in to buy bonds, investment, short-term investment assets. So hot money flows also count in the financial account and give you a more positive balance. And obviously we prefer, or every country prefers, these direct investments, these long-term investments, to the hot money flows, and the short-term monetary investments. But we take it where we can get it, and for now, for various reasons, a lot of investors aren't comfortable investing long-term in Nigeria, so we have a lot of hot money coming into the country right now. And it also covers things like funds associated with buying fixed assets like land as well. So we have the current account, which is more about like solid things, goods, services, um, wages, investment income, and government transfers. And we have the financial account, which is more about foreign direct investment and portfolio investment, hot money. And that's what we're trying to do, right? Improve our financial account by getting lots of like hot money in right now. But we're hoping that at some point we'll be able to straighten out our ease of doing business enough to also get cold money or foreign direct investment as well. So, people are calling um, our current economic policy 21 items, I think they were. The way that we've closed the borders, they're calling it Bannonomics. And um, some people agree with it, some people don't. But I just want to sort of explain the thinking behind it. So, as we know, aggregate demand is equal to GDP, and GDP is equal to, I keep on repeating this equation because once you understand this equation, then almost any question in macro you can answer referring to whether it affects any of these four things. So GDP is equal to government spending plus investment plus consumption plus net exports. Um, the exchange rates seen on the internet are the nominal exchange rates, but the exports and imports are actually determined by the real exchange rates that are affected by inflation. So when we sort of try and ban different items from coming into the country, and we're trying to stimulate domestic production of some of those items and empower local producers to be able to export. So we're trying to improve the NX area of GDP, which is really, really important for growth and probably one of the quick wins that we can do in our economy. So again, I'm not making any judgments at all. I'm not saying it's right or wrong, but I'm saying that that's, the thinking behind it, to raise GDP by raising their exports and protecting local local producers.